Hey, here we go. Part two of the Kansas pre-licensing life insurance course. Final exam tips. As your Kansas life insurance license exam approaches, it's important to be fully prepared, not only in terms of your knowledge, but also mentally and physically. Try to get some sleep before you get some sleep the night before. I mean, you should know this stuff before you go in, before you cram in the night before, right? Last minute study strategies. In the days leading up to the exam, it is important to focus on strategies that reinforce your knowledge and boost your confidence without overwhelming yourself. Review key concepts. Focus on reviewing the most important concepts, such as life insurance policies, Kansas specific regulations, and key terms. Flashcards and summary notes are useful for this. Revisit any areas where you struggled in practice exams, but avoid trying to learn new materials at this stage. Focus on reinforcing what you already know. Take short practice tests. Instead of full length practice exams, take shorter quizzes that focus on specific sections like life insurance, Kansas regulations, and such. This allows you to quickly review concepts and identify any last minute gaps in your knowledge. Rest and recharge. Okay. Ensure you get plenty of rest the night before the exam. Overstudying at the last minute can lead to burnout. So also time to and so gives you time to relax. Okay. Take short breaks between study sessions and maintain healthy eating and sleeping habits. Summarize main points. Create a one-page summary of key concepts and formulas that you can review the night before the exam. This will give you a quick refresher without having to go through all your notes. Manage exam anxiety. It's natural to feel nervous before a major exam, but managing anxiety can improve your focus and performance. Here are some strategies to keep anxiety in check. Oh, this reminds me. Let's say you have a bona fide test anxiety issue, which I have. Okay, mine's bona fide. I mean, I went to a psychologist, one of those, and so I get extra testing time. So if you have that and it's documented, please provide it to Pearson View before you take the exam, before you show up for the exam. Make sure you do it while you register. Okay, and if you forgot to do it, just get with them as soon as you can. Okay, get that on record so they give you more time. Breathing techniques. Practice deep breathing or mindfulness exercise to calm your nerves. Slow, deep breaths help lower your heart rate and reduce anxiety. Positive visualization. I know I can. I know I can. I know I can, right? Visualize yourself confidently answering questions and completing the exam. Positive visualization can help reduce fear and build confidence. You've heard about that train that I can, I think I can, I think I can, I think I can, going up the hill. Did it. Focus on the process, not the outcome. Instead of worrying about passing or failing, concentrate on doing your best in each moment. Stay present during the exam and focus on each question one at a time. You can always mark it and come back, okay? Even if you're not sure. And usually, what do they say? If you're not sure, select C, but don't answer all C on everything, okay? And also, usually, if you're trying to second guess, let's say you mark a letter like A, B, C, or D, or you mark one of those and you're not sure, and you say, I'm going to come back to it. Maybe I'll change it. Usually, if you change it, it's wrong. Okay. Usually you're right with first guess. Avoid comparisons. Don't compare yourself to others on exam day. Each person has their own pace and process. Stay focused on your exam strategy and trust your preparation. Exam time management. Time management is crucial during the exam to ensure you answer all the questions. You don't rush through important details. Here are some tips for managing your time effectively. Pace yourself. Start by quickly reading through the entire exam to get a sense of the question types of lengths. Set a time limit for each section to ensure you have enough time to answer all questions. Answer the easiest questions first. Begin by answering the questions you are confident about. These helps build momentum and ensures you score points on early on. Make the more difficult questions for review and come back to them later. Don't spend too long on any one question. If you find yourself stuck on a question, move and return to it later. Spending too much time on a single question can eat up time you need for other sections. Review your answers. If you finish early, using the remaining time to review your answers, look for any questions you may have skipped or flagged for review. What to bring the exam day. It is essential to bring right materials to exam to avoid unnecessary stress or delays. Here's what you need to take with you: valid identification, confirmation registration, calculator if allowed. I don't see any place in here that I need a calculator, but I don't know, maybe you'll see something. Bring 2 forms of identification. One must be government issued ID, such as driver license or passport. Make sure your name and on the ID matches the name you use to register for the exam. Okay. Confirmation of registration. Bring a printout of digital copy of your exam registration confirmation. This may be required for check-in at the testing center. Check calculator if allowed. Check whether a calculator is permitted for your exam. If so, ensure it complies with the testing center's regulations. Non-programmable, basic functions only. Water and snacks. Bring a bottle of water and small snacks in case you need a quick break. However, keep in mind that these may need to be stored outside the testing room and consumed during authorized breaks. Comfortable clothing. Dress in comfortable layers. Testing rooms may vary in temperature, and you want to ensure you can adjust the comfort level during the exam. I'm always freaking out on exams. It's just the way I'm built. Right? Look, if I can do this, you can too. It took me 2 times. I didn't quit. Failed the first time. I think I got a 68. Understanding the testing environment. Knowing what to expect at the testing center can help alleviate stress on exam day. Familiarize yourself with the exam process and environment to stay focused. By the way, my wife got almost 100% on hers. She's really smart. Arrive early. Plan to arrive at least 30 minutes before your scheduled exam time to allow for check-ins. Procedures. Testing centers can have strict punctuality policies, and late arrivals may not be admitted. That's terrible. Check-in process. You'll need to be asked to present your ID, and some centers may take a photo or fingerprint for a verification. I've had that happen to me. I was taking a security exam. Be prepared for a brief security check, and personal items such as cell phones, bags, and notes are usually not allowed in the testing room. Exam room setup. The exam is typically administered on a computer, and you will be assigned a workstation. The room will likely be quiet, but you may be given earplugs or headphones to block out the noise. I recommend that. Just put them on. Follow exam instructions before starting the exam. Carefully read the instructions provided on the screen. This will help ensure you understand the format, navigation, and other guidelines. Breaks. Some exams offer scheduled breaks while others do not. Be aware of the rules regarding breaks and use them to stretch, hydrate, and refresh your mind. By the way, you can't grab your books or your notes. That's a no. Don't do that. Don't write on the back of your hand or anything. All right. Don't be rolling up your sleeve and putting answers. That ain't gonna happen. Don't do that. I'll kick you out. You probably never get a chance again, right? Taxation and insurance. Federal income tax considerations. Insurance products are generally subject to specific tax treatment under federal law. The tax treatment varies depending on the type of insurance policy, how benefits are distributed, and whether the policy accumulates cash value. The key federal income tax considerations include tax-free death benefits. In most cases, life insurance death benefits paid to beneficiaries are considered non-taxable income, allowing families to receive the full benefit amount. Tax-deferred growth. The cash value in permanent life insurance policies and annuities grows tax-deferred, meaning policyholders do not pay taxes on the growth until it is withdrawn. Deductions for medical expenses. Health insurance premiums may be, oh, well, I don't think we're doing that one. Okay, that's something else. Employer-sponsored, no, we're not doing that either. Taxation of life insurance. Life insurance policies have specific tax rules that vary based on type of policies and how benefit. Didn't we just talk about that? How it's distributed. Understanding these rules can help policyholders, agents make informed decisions. Tax-free death benefits. Gosh, we just talked about that. In most cases, death benefits paid out to beneficiaries are not considered taxable income under federal law. This allows full amount to go directly to the beneficiary without tax consequences. That's like awesome. That's just an awesome thing. It's awesome. Okay. That the policy holder or policy owner, insured, and beneficiary are different individuals, like a third party arrangement, the death benefit may be subject to gift tax or other tax considerations. So get with your, okay, for the test. This is for the test, okay? Tax, I gotta remember that. We're talking about tests right now. Taxation of cash value. For permanent life insurance policy, the cash value grows on tax-deferred basis. This means policyholder does not owe taxes on the growth until it is withdrawn. If a policyholder withdraws funds or takes out a loan against the cash value, the amount above the total premium contributions, the basis, is taxable as ordinary income. Policy loans. Policy loans are not considered taxable as long as the policy remains in force. However, if the policy lapses or is surrendered, any outstanding loan amount exceeding the policy's basis may be subject to tax. We'll discuss that later, but that's interesting, isn't it? Make sure you understand that between the taxation of cash value and the policy loans. Surrender of policy. If the policyholder surrenders the policy and receives its cash value, the portion of the surrender amount exceeding the premium paid is subject to income tax. Taxation of annuities. Annuities are another insurance product with unique tax considerations, particularly on how they accumulate and distribute funds. The tax treatment of annuities depends on whether they are qualified, part of a retirement plan, or non-qualified, purchased with after-tax dollars. Tax-deferred growth. Like life insurance, the earnings in the annuity growth tax-deferred, meaning the policyholder does not owe taxes on the growth until it is withdrawn. This makes annuities an attractive option for retirement savings. That's a fact. Withdrawals. Withdrawals from a non-qualified annuity are taxed on last in, first out, LIFO basis, meaning that the earnings growth are withdrawn first and are taxable as ordinary income. Qualified annuities, such as those held in an IRA, are subject to rules governing the retirement account. Withdrawals are typically fully taxable as contributions to the account were made pre-tax. Annuitization. When an annuity is annuitized, converted into a stream of payments, each payment is divided into two parts: a return of the original investment, which is not taxable, and the earnings portion, which is a taxable income. The exclusion ratio is used to determine how much each payment is taxable. Early withdrawal penalties. Withdrawals from an annuity before the age of 59.5 are subject to the 10% early withdrawal penalty unless an exception applies. This penalty is in addition to income tax owed on the earnings portion of the withdrawal. Taxation. Okay, so let me take a break. Stop. Gotta get some Kansas specific tax laws related to insurance. In addition to federal tax laws, Kansas imposes state-specific tax laws that impact insurance companies, policyholders, and agents. These laws regulate taxation of insurance premiums, as well as other aspects of insurance taxation within the state. State premium taxes. Insurance companies operating in Kansas must pay a premium tax on the premiums they collect from policyholders. This tax is a percentage of the total premiums written by the insurer in Kansas. The current premium tax rate in Kansas is typically 2 to 3%, depending on the type of insurance. Insurers pass this cost along to policyholders in form of premiums. I don't think that's very fair, but it is what it is. The current, okay, we did it. So taxation of life insurance proceeds in Kansas. Life insurance death benefits are not subject to Kansas state income tax. Cool. Mirroring federal tax rules that exempt death benefits from taxation. Annuities. Kansas follows federal tax guidelines for annuities, including tax-deferred growth and taxation on withdrawals as ordinary income. Tax deductible of premiums. Let's see here. No, that's for health. Life insurance premiums. Premiums paid for personal life insurance policies are not tax deductible. However, if an insurance policy is used as collateral for a business loan, the premiums may be deductible in certain circumstances as a business expense. That's cool. We're going to talk about annuities. Annuities are financial products that provide a series of income payments, typically used as a tool for retirement planning. They offer a combination of insurance and investment features, which allows individuals to grow their money on a tax-deferred basis and receive periodic payments. Types of annuities. Annuities come in several forms, in which unique features and benefits that cater to different financial needs and goals. The main types of annuities are fixed annuities, variable annuities, and indexed annuities. They can be classified under either immediate or deferred annuities. By the way, variable annuity, remember? Securities. Gotta have a securities license. Fixed annuities. Fixed annuities guarantee a specific rate of interest for a set period of time. The insurance company assumes the investment risk, making this a low-risk option for the individual seeking steady, predictable returns. At the end of the accumulation phase, the policyholder receives a fixed series of payments, typically for the rest of their life or for a set number of years. Variable annuities, which you must have, securities license. Variable annuities allow policyholders to invest in a range of sub-accounts, typically comprising of mutual funds. The performance of these investments determines the annuity's growth and individual payouts. While variable annuities offer potential for higher returns, they also carry greater risk since the value of the annuity can fluctuate based on market conditions. Just a caveat here. I like fixed indexed annuities, but that's not on the test. I like them really well. And we'll discuss that once you get in. And indexed annuities combine features of both fixed and variable annuities. These returns are linked to the performance of the stock market index, like, for example, the S&P 500. However, the annuity typically offers a minimum guaranteed interest rate to protect against market downturns. Indexed annuities are attractive for individuals seeking higher potential returns than fixed annuities, but with less risk than variable annuities. Immediate and deferred annuities. Annuities are further categorized based on when the income payments begin. Immediate or deferred. Immediate annuities. With an immediate annuity, the policyholder makes a lump sum payment to the insurer, and the income payments begin almost immediately, typically within 12 months of the initial purchase. This type of annuity is often used by retirees who are ready to start receiving regular income immediately after purchasing the annuity. Deferred annuities. Deferred annuities have the accumulation phase where the policyholder contributes to the annuity any income payments at a later date, typically at retirement. Mine's 15 years. I have one that's had to wait 15 years to turn on. It accumulates. Okay. Deferred annuities allow tax-deferred growth during the accumulation phase, making them a useful vehicle for retirement savings. At the end of the accumulation phase, the policyholder can choose to annuitize, convert the lump sum into periodic payments, or take withdrawals from the account. Annuity policy provisions and riders. Annuity contracts contain various provisions and optional riders that allow policyholders to customize their coverage to meet their needs. Free look period. Annuity contracts in Kansas typically include a free look period, which gives the policyholder a set number of days, usually 10 to 30 days, to review the contract and cancel for full refund if they're not satisfied. Surrender charges. Most deferred annuities include surrender charges if the policyholder withdraws funds within a certain period, typically for the first 5 to 10 years of the contract. These charges decrease over time. By the way, just another caveat, some of these annuities, you can take out 5 or 10% without a surrender charge. So they're not, this is for the exam. All right. We're just later on, we'll talk about product. Okay. Guaranteed minimum income benefit rider, GMIB. This rider guarantees that the policyholder will receive minimum level of income regardless of market performance. It provides a safety net for variable annuities. Guaranteed lifetime withdrawal benefit, GLWB rider. This rider allows the policyholder to withdraw a fixed percentage of their annuity balance each year for life, even if the annuity's balance is depleted. Remember, those are two riders. It's added and there's fees to have them. A death benefit. Many annuities include a death benefit that pays the remaining account balance or a guaranteed amount to the beneficiary upon the policyholder's death. Inflation protection. Some annuities offer an inflation protection rider that adjusts income payments based on inflation to help the annuity keep pace with the rising cost of living. Suitability and ethical sales practices in annuity sales. Given the complexity of annuities, ensuring that the product is suitable for the consumer's financial goals and risk tolerance is paramount. Kansas, like many states, have adopted suitability standards to protect consumers from inappropriate annuity sales. Just another caveat, okay? So not everybody can get one because of reasons. And you go through the suitability questionnaire with your client, and sometimes you can't help them. Sometimes you can't get it, okay? Just be aware of these things. So for the test, suitability standards, agents must gather detailed information about the client's financial situation, investment objectives, and risk tolerance before recommending an annuity product. The agent must ensure that the annuity fits the client's needs, especially regarding the time horizon, liquidity needs, and risk tolerance. That liquidity needs will throw out a lot of people. Okay. Ethical sales practices. Agents must provide full disclosure of all fees, risk, and features of the annuity, including surrender charges, rider costs, and potential market volatility for variable or indexed annuities. Misleading or deceptive sales tactics, such as exaggerating potential returns or downplaying risks, are prohibited. Agents must not pressure clients into purchasing an annuity or sell them an annuity that does not align with their financial goals. In Kansas, agents must maintain accurate and complete records for their suitability analysis and recommendations for a set period, usually 5 years, as required by law. I might just keep it forever. Consumer protection. If a client believes that annuity was sold improperly or without adequate disclosure, they can file a complaint with KID. Agents who violate suitability or ethical standards can face disciplinary actions, including fines, suspension, or loss of their license. Ouch. I don't like that fines part. Kansas regulations on annuities. Kansas has specific regulations governing the sale and management of annuities, designed to protect consumers and ensure that the insurance companies operate ethically and responsibly. Disclosure requirements. Kansas law requires insurers to provide clear and comprehensive disclosure documents before the sale of annuity. These documents must include information on fees, surrender charges, interest crediting strategies, and market risk. For variable and indexed annuities, the insurer must explain how returns are calculated and what protections are in place if the market performs poorly. Free look period, again, 10 to 30 days. Non-forfeiture rules, Kansas has adopted non-forfeiture rules to ensure that the policyholders receive fair value if surrender of an annuity early. These rules guarantee that policyholders retain a portion of their cash value even if they cancel the contract before maturity. The non-forfeiture value is typically calculated as a percentage of the total premium paid minus any withdrawals and surrender charges. Regulations of indexed and variable annuities. Let me take a break just a minute. I gotta get some drink. Due to the complexity and potential risk of an indexed and variable annuities, Kansas requires insurers to provide detailed explanations of how returns are calculated, including caps, participation rates, and minimum guarantees. Indexed and variable annuities are also subject to Kansas suitability laws, ensuring that these higher risk products are only sold to individuals who can tolerate the risk associated with the market volatility. Annuity suitability law, Kansas requires agents to follow National Association of Insurance Commissioners, or NAIC, suitability and annuity transaction model regulation. This law mandates that agents conduct thorough assessment of a client's financial situation before recommending an annuity. Agents must obtain specific information such as a client's income, financial objectives, and existing assets, and maintain detailed records of these suitability assessments. Another break, just a minute. Okay, we're going to talk about ethics and insurance. Kansas Code of Ethics for Insurance Professionals. We're almost done. This is the last section. Okay. Kansas Code of Ethics for Insurance Professionals set forth the standard of conduct that agents, brokers, and insurance companies must follow. These ethical principles are designed to promote honesty, integrity, and accountability of all aspects of insurance sales, servicing, and claims processing. Honesty and integrity. Insurance professionals must be truthful and transparent in dealing with clients, insurers, and regulatory bodies. Misrepresentation, deception, or withholding information is strictly prohibited. Remember what can happen to you. Fair treatment. All clients must be treated fairly and equitably. EQUITABLY. Whatever that is. This includes presenting policies accurately and ensuring that products meet the needs of the client. Confidentiality. Insurance professionals must safeguard the personal and financial information of their clients. Client data must only be shared with authorized individuals and must be protected from misuse. Competence. Insurance professionals must stay informed about changes in laws, products, and industry practices. Continuing education is required to maintain high level of competence. Professional conduct. Agents and brokers are expected to maintain professionalism in their interactions with clients, colleagues, and insurers, avoiding any conduct that would bring disrepute to the insurance industry. Failure to adhere to Kansas Code of Ethics can result in disciplinary action, including fines, license suspension, and revocation. That might be on the exam. They only said it 3 or 4 times now. Ethical practices in life insurance sales. Ethical practices in life insurance sales are critical to building trust with clients and ensuring that the insurance industry operates fairly. Ethical sales practices are designed to protect consumers from being misled or sold inappropriate policies. Accurate representation. Agents must provide accurate and complete information about the insurance products they sell. Misrepresenting the terms, conditions, or benefits of the policy is a violation of ethical standards. Exaggerating potential benefits or downplaying the risk of associated with a policy is unethical and illegal under Kansas law. By the way, I because of the product I sell, I have an illustration that the insurance company provides, so it's in compliance, and I go over with the client with it, just line by line. Full disclosure. Agents are required to disclose all relevant information about a policy, including fees, premiums, exclusions, and any potential risks. Policyholders should be made fully aware of the coverage they are purchasing, and any limitations or exclusions must be clearly explained. Avoiding high pressure sales. Ethical agents avoid using high pressure tactics to coerce clients into purchasing a policy. Clients must have the time and space to make informed decisions without undue influence. Recommendations based on client needs. Agents must recommend products that are suitable for the client's financial situation and long-term goals. Selling a policy does not meet the client's needs or that the client cannot afford is a breach of ethical obligations. Responsibilities to clients. Insurance professionals have a fiduciary responsibility to act in the best interest of their clients. This means putting the client's needs ahead of the personal financial gains and ensuring that the products and services offered are appropriate for the client's unique circumstances. Acting in client's best interest. Agents must act as fiduciaries. Wow, we just said that. Meaning they must prioritize the client's interest above their own. This includes recommending policies that provide the best value for the client rather than those that are offered at the highest commission for the agent. Clear communication. Insurance professionals must communicate clearly and effectively with clients. This includes explaining policy details in language that the client can understand and answering any questions the client may have. Just don't go over their head. Just be on it, be with them. You don't have to prove that you're better. You might know a lot, but just be nice. Ongoing support. Agents are responsible for providing ongoing support to their clients, including assisting with policy changes, claims processing, and periodic review of their insurance needs. Conflict of interest and transparency. A conflict of interest arises when an insurance professional, personal or financial interest conflict with the duty to serve the client's best interest. In the insurance industry, it is essential that agents avoid conflict of interest and maintain transparency in all transactions. Identifying conflicts of interest. Okay. Common conflicts of interest in insurance include recommending policies based on the agent's financial incentives rather than the client's needs, or selling additional products that benefit the agent but are not necessarily for the client. Transparency and compensation. Agents must disclose how they are compensated, usually any commissions or incentives they receive for selling a particular product. Clients have the right to know if the agent's recommendations are influenced by financial incentives. You know what I mean. Avoiding self-dealing. Agents must avoid engaging in transactions where they stand to personally benefit at the client's expense. This includes purchasing policies for themselves using clients' funds or steering clients towards products that benefit the agent financially. Unfair trade practices and market conduct. KID regulates unfair trade practices and market conduct within the insurance industry. I think we've said that before. These practices are prohibited by Kansas law and include any actions that deceive or defraud consumers, manipulated the market, or provide unfair parties. So, misrepresentation. Misrepresentation, a term or a benefit of a policy, or making false statements about the insurer or other policies is considered unfair trade practice. This includes providing misleading comparisons between products. We mentioned that before. Rebating. Now, we didn't mention rebating. Oh, this is new. This is new to us. Offering clients a portion of the agent's commission or other inducements to purchase a policy is prohibited under Kansas law. Rebating undermines the integrity of the sales process and considered unfair competitive practice. False advertisement. Insurance advertisements must be truthful and must not exaggerate the benefits of a policy or make unsupportive claims. False advertising is a serious violation of market conduct standards in Kansas. Twisting. Twisting occurs when an agent persuades a policyholder to replace an existing insurance policy with a new one using misleading or incomplete information. Twisting is illegal and unethical because it can result in financial harm to the client. Almost like churning. Churning and twisting is two different things, but twisting is in there. Kansas specific examples of fraud and misrepresentation. Kansas law takes fraud and misrepresentation in the insurance industry seriously. Fraud can occur in various forms, from false claims to misleading policy applications, and Kansas law has strict penalties for those found guilty of such actions. Policy application fraud. Yeah, don't do these things. Policyholders or agents who intentionally provide false information on insurance applications, such as misstating age, income, or medical history, are committing insurance fraud. These types of frauds is punishable by law in Kansas and can result in denial of coverage or claims. Claims fraud. Submitting false claims, inflating the value of a loss, or staging an incident to collect insurance proceeds is considered insurance fraud. In Kansas, perpetrators of insurance fraud face fines, legal action, and potential imprisonment. Oh, well, that's the first time I saw that one. Agent misrepresentation. Agents who misrepresent the nature of the benefits of the policy, either verbally or in writing, are violating Kansas insurance regulations. This includes false claims about potential returns of an annuity, overstating life insurance benefits, or omitting key policy exclusions. That's why you just go through the policy with them, until they got it. Just don't dump it off on their desk and don't go over it. I've seen that. Don't do that. Suitability requirements of best practices. Kansas has adopted suitability standards that ensure insurance products are appropriate for the client's financial goals and circumstances. These standards are particularly important for life insurance and annuity sales, where the products are often complex and long-term. Suitability requirements. Agents must assess the client's financial needs, risk tolerance, investment horizon, and overall financial situation before recommending a policy. I know we went over that before. Agents must document the suitability analysis and retain records for regulatory review. We've said that before. Best practices for suitability through needs assessment. Agents should conduct a comprehensive assessment of the client's financial situation, including their income, assets, and existing insurance coverage. I know we've said this before. Tailored recommendations. Recommendations should be tailored to the client's specific needs and goals rather than offering a one-size-fits-all product. Regular reviews. An agent should review their client's insurance coverage regularly to ensure that it continues to meet with involving needs, especially their major life events such as a marriage, birth of a child, or retirement. Clear documentation. All suitability assessments and recommendations should be clearly documented to protect both the client and the agent in case of future disputes. We are done. We're done. Good luck. Any questions you are concerned, you can email me, chris@mybrody.com. That's CHRIS@MYBRODIE.com. Or most of you will know my text number, so just text me. All right. Have a great day.